Someone gets a raise, opens a tax chart, sees a higher percentage, and panics. I'm in a higher bracket now, so I'm taking home less. That story spreads every spring. It's almost never how the federal income tax works for ordinary wages. Tax brackets are stacked layers. You pay one rate on the first slice of taxable income, a higher rate only on the next slice, and so on. Today, how brackets actually stack, the difference between marginal and effective rates, the raise myth with illustrative math, and why your paycheck withholding is not the same as your final tax bill. If nobody taught you this in school, that's normal. We'll keep every example illustrative and point you to IRS tables for the current year. Brackets change, the stacking idea does not. Quick note, this is general education, not tax advice. Brackets, deductions, and filing status change by year. I'll point you to IRS.gov, and for your situation, check a qualified tax professional or the IRS withholding tools. Picture taxable income as a set of buckets stacked on top of each other. The bottom bucket is taxed at the lowest rate. When that bucket fills, only the dollars that spill into the next bucket are taxed at the next rate. You do not dump your entire salary into the top bucket the moment you touch it. That's why people say marginal. It means the rate on the next dollar, not a single rate on every dollar you've already earned. If you remember nothing else, crossing into a new band is not a flat tax on your whole life. Your marginal rate is the rate that applies to your next dollar of taxable income, the top slice you currently touch. If a chart says you're in the 22% bracket, that usually means 22% applies to income in that band, not that your whole paycheck is taxed at 22. When people say a raise puts them in a higher bracket, they mean their top slice moved up, not that every prior dollar got repriced. When coworkers say, "I'm in the 22% bracket," translate that as, "My next dollars face 22, not Uncle Sam takes 22 of everything." Your effective rate is the average, total income tax divided by taxable income, or sometimes people casually compare tax to total income. Either way, the effective number is almost always lower than your top marginal bracket because those lower slices were taxed at lower rates. That's the comparison that calms the panic. Marginal answers, what happens to the next dollar? Effective answers, what fraction of my income became federal income tax? If your effective rate and your top bracket are close, you may have fewer lower slices. Still not a rewrite of every prior dollar. Illustrative only, not current year brackets. Imagine taxable income of $60,000 with stacked rates where the first slices are lower and only the top portion hits a higher percentage. The tax bill is the sum of each slice, not 60,000 times the top rate. If someone wrongly multiplies the whole amount by the top rate, they'll invent a tax bill that is way too high and invent a raise horror story that isn't real. Run the same mistake with a raise and you'll invent a story where earning more somehow makes you poorer, which is almost never the federal bracket mechanism alone. Also remember, brackets apply to taxable income, not your headline salary. Pre-tax retirement contributions, the standard or itemized deduction, and other adjustments can change which slice you reach. Two people with the same gross pay can sit in different places on the chart. So before you spiral about a bracket, ask what number the chart is actually measuring, taxable income after those steps. Pre-tax 401k contributions, HSA contributions when eligible, and the standard deduction are common reasons two similar salaries land differently. But here's the mistake that quietly freaks people out: treating the top bracket as a flat tax on the whole paycheck. That myth makes raises feel pointless and overtime feel cursed. In progressive systems, crossing a threshold only changes the rate on dollars above that line. Your lower slices keep their lower rates. The scare story usually comes from mixing up marginal and effective, or mixing income tax with payroll taxes like Social Security and Medicare, which are separate. State income tax, if any, is another layer with its own rules. Don't paste a federal myth onto a state paycheck line. In about a minute, I'll give you the tax bracket cheat sheet to screenshot, marginal, effective, and the raise myth in one place. But first, a simple raise walkthrough. Illustrative raise math. You earn more, so some new dollars land in a higher slice. Those new dollars face the higher marginal rate. The dollars that were already in lower slices do not get rewritten to the new rate. So, take-home usually still rises with a raise. What changes is how much of the raise you keep after tax. If your paycheck barely moved, look at withholding elections, benefits, and payroll taxes. Not a cartoon that says, the government took the whole raise. A quick sanity check. If take-home rose, the bracket didn't eat the raise. If take-home barely moved, audit withholding and benefit elections before blaming the bracket chart. Payroll taxes are a separate stack. Social Security and Medicare come out of wages under their own rules. They are not the same thing as the income tax brackets on Form 1040. When someone says, I got taxed more, ask which line moved: federal income tax withholding, state tax, or FICA. Mixing those labels is how a normal raise turns into a conspiracy theory in a group chat. Bonus and overtime withholding can also look aggressive on a single check, even when your annual bracket math is fine. Another reason one scary stub isn't a verdict. Now, the one thing nobody tells you, paycheck withholding is a deposit system, not your final tax rate. Your W-4 tells your employer how much to send ahead. Getting a refund means you overdeposited. Owing means you underdeposited relative to your eventual bill. Crossing a bracket can change withholding, but a weird refund is not proof that the raise puts you in a worse bracket. Use the IRS tax withholding estimator when life changes. Raise, second job, marriage, big side income. Updating a W-4 after a raise, marriage, or side income is ordinary adulting, not an admission you got bracketed. What to check next, in plain English. Look up the current year IRS bracket tables for your filing status. Estimate taxable income, not just salary. Separate marginal from effective. And rerun withholding when income changes. This channel explains the system. It does not prepare your return. If your situation is messy, equity compensation, multi-state, self-employment, get a pro. The goal here is ending the myth that a raise can make you poorer through brackets alone. Bookmark the IRS tax withholding estimator and the current publication with the bracket tables. Primary sources beat a viral chart with no year on it. Screenshot this tax brackets cheat sheet. 1. Brackets are stacked. Higher rates hit higher slices only. 2. Marginal rate is the next dollar rate. 3. Effective rate is the blended average and is usually lower. 4. Taxable income is not your headline salary. 5. Withholding is a deposit. Use the IRS estimator when life changes. Free download of this sheet is linked below, plus the Adulting Starter Kit. If this cleared the raise myth, subscribe to the Adulting Guide. We translate adult money systems into plain English every week. Comment the money topic school skipped for you, and watch the next video for the debt payoff math that pairs with this. Avalanche versus snowball. Share this with the friend who swears raises are pointless because of brackets. Then send them the debt payoff video if interest math is their next fight.